All right. Thank you so much for coming to check out the StashCast, where we have interesting conversations with interesting people focused on commercial real estate and the world of prop tech. The StashCast is brought to you by Needle. What if you could use data and analytics to predict which transactions were going to occur before anybody else? You can with Needle. Come check it out at Needle, NEDL.us to learn more. All right, David, thank you so much. Thank you for being here. Thanks for joining us. I'm excited to have you. If we want to start, why don't give yourself a brief introduction? I know who you are, but maybe people who you are.
Sure. First of all, Stash, thank you so much for having me on your podcast. It's really a pleasure to join you. I always enjoy our conversations, and it's really great to be a guest with you on your podcast. My name is David Ostreicher. I am the president and founder of the Brookview Companies. The Brookview Companies is a privately held multifamily group operating in all markets across the Midwest and Southeast. The Brookview Companies has been active for the past 10 years. Over the past 10 years, we've privately acquired close to $400 million in multifamily assets and looking to continue to expand and grow as the years continue.
That's awesome. So have you always been in multifamily, or you're not 10 years old? So how did you get started?
So actually, my career, I began as an attorney. I was a corporate and real estate attorney focused on business transactions, joint venture structuring, on other groups' real estate transactions, and spent a decade doing that. Made a lot of really good connections in the real estate world, on the ownership side, on the lending side, really just learning the business from behind the scenes as an attorney. And then about 10 years ago, I left law and decided to start my own real estate company, which was the Brookview Companies, and really never looked back, and I couldn't be happier and just truly have a lot of satisfaction in my career and what we're doing here and the way we're doing it.
So you went into law initially. How was it? Were you just unsatisfied, unhappy with your law career, or like why decide to transition out of law and into real estate?
Yeah, I enjoyed being an attorney, but I would say at a certain point when you're working on other people's deals so frequently, you start to feel that itch to do it yourself. And I never could have started the Brookview Companies without spending those 10 years as an attorney, learning the real estate business from that angle of things. But I always really did have that drive and desire to really become a player on my own within the space, as opposed to doing it for other people's deals. When the opportunity presented itself and the stars aligned, I was really excited to take that jump and try to do it on my own.
Yeah, so I'm curious, what was that first opportunity or the stars aligning that you said, you know what, I think I can do this? What
Yeah,
month were you?
this was back in 2013. We started the Brookview Companies, and I actually started it originally with a partner, a man named Barry Pessin. He was probably about 30 years older than me, very seasoned and he had all the knowledge that I was trying to build. And when we started this, we were starting it as partners, the two of us, where he would teach me the ropes as far as underwriting, operations, all the things you need to run your own shop, and I would raise the money. That was our original plan. We started with about 20 family and friend investors. We made a $40 million acquisition in Columbus, Ohio, and that was our first deal. So the plan was for the two of us to do it together, and he was just an extraordinary man. Unfortunately, after we made our first acquisition, he passed away. And then I was on my own and really had to learn the ropes by myself and how to grow the Brookview Companies and where to take our next steps. But our first initial step was together. And once we made that first acquisition, it's always that first one that is really your biggest challenge, when you don't have a reputation yet in the space, when the brokers don't know you yet, can't really comfortably vouch for you yet. So once we got that under our belt, then it was easier to get the ball really rolling.
It's almost like he shepherded or chaperoned you into your first deal, and whether he knew it or not, was like, all right, you've got enough to be dangerous. Now go figure it out on your own.
That's exactly how it was. I have a ton of gratitude towards him. I don't know if we ever would have been able to get that first deal done and get the ball rolling without him. And I like to hope that he'd be very proud of what we've done since.
I'm sure he is. Absolutely. So you bought your first deal in Columbus. What was that like going from a law career to now you're running a multifamily property, asset management, and then building a company? How was that transition?
Yeah, it was certainly challenging. And I think one of the biggest challenges in fundraising, especially when you're not raising from institutional capital and you're really just tapping into a network of high net worth individuals as your capital source, it's extremely challenging at the outset to really get people to trust you with their hard earned post tax savings, and you don't really yet have the track record to speak of. You can't really point to, hey, this is what I've done. You're really selling them on a vision and on yourself more than necessarily your operating history. So that was truly a challenge, especially jumping right into the multifamily space when you're raising tens of millions of dollars for an acquisition. So I think that was really the biggest challenge, is how to get people to trust you with your money and with their money, and show them that, hey, I'm someone you can believe in and that will deliver for you.
Yeah. So how do you how did you do that?
So our first deal, and this is something I take a lot of pride in how we run the Brookview companies. Our first deal, we ended up with about 20 family and friend investors, and they were really investing more in, I would say, the Ostreicher history more than the David Ostreicher history. And they really took a huge leap of faith in putting money with us. And as we've grown over the years, we've always, over the past 10 years, we've resisted the urge to accept institutional capital. We don't have any partners. We don't have different classes of equity. We raise money on a very simple structure where the Ostreicher family are the lead investors on every Brookview acquisition with our own dollars as part of the pool with no preferences. And we raise the money from our group, and where we started with 20 family and friend investors. There's no substitute for being present and for delivering and being held accountable. That it's not just that you raise the money and then you disappear, but even after the deal closes, you're the one who communicates with the investors, lets them know their money's not forgotten. This is what's going on with your deals. And over the years, we've grown just organically as we've performed on different deals where someone once introduced us to their business partner, their brother-in-law, their investment partner. And at this point, we have over 140 unique investors with a waiting list over 30 deep, waiting to get into our deals.
Wow, that's great. So it sounds like it's not just for you, the tack for success has been, don't just bring it in the door, but make sure you're having open communication and dialogue with these folks afterwards, saying, hey, here's what's happening, here's what we're doing. Do you handle the investor relations part of things?
Yeah, that's something that I think we do a little bit uniquely. Is as we've grown, we have an operations team, we have an acquisitions team, we have a team in charge of capital projects on the various properties. But the one thing I never let anyone touch other than myself is anything investor relations. So whether it's an investor, we have investors who every single deal puts seven figures into anything we're doing. So whether it's those investors or someone putting in their first $50,000 in a Brookview project, I'll be the one personally who will call them, walk them through a new deal, what we're seeing in the deal, where we see the value. And then after the acquisition, every single investor has my cell phone number. Every investor communication comes from me personally. Anyone can reach out to me. I will get the answers from other people on my team, but I'm never handing you off. I think when someone invests with a group like Brookview, where you're not investing with this huge institutional group, I think sometimes we all have the inclination to sometimes want to feel that's like a JP Morgan and operate that way. But I try to remind myself, people invested with us because of how we started. And I never want to lose that vision. So no one will ever get an email from investorrelations@brookview.com. It's always from David Ostreicher. And I always want every investor to be able to comfortably know if someone asks them what's going on with this investment of yours, that they can comfortably give a description of what's going on and that they have that open line of communication with me personally. And I feel like there's really no replacement for that.
Does Brookview function on EOS? Do you know what EOS is?
No.
EOS stands for Entrepreneurial Operating System. And a lot of companies, probably your size and bigger and smaller, Capstone functions on EOS. It's a way that you handle meetings and kind of establishing roles and responsibilities for people. You'd be the visionary of your firm. Might be something to check out, because I imagine that I say you're pulling your hair out, but you don't have any hair. I imagine it's stressful running a company. Like,
you know what? I feel it's like everything else. I think of Brookview as operating in three separate boxes. When someone says to me, what does Brookview do? I think of the business as there's three boxes. There's the operations side, where we're focusing on our existing portfolio, the performance of our existing properties, how to best manage those properties. And we have that first box. Then we have the acquisition side of things, where we're all constantly underwriting, financially modeling, communicating with our strong broker relationships and making sure those relationships are strong and really feeding the future growth of Brookview. And then we have the investor relations side of things, where we are constantly trying to grow that investor base, make sure the investor base feels very comfortable with their existing investments with us. And I think the combination of those three things is what really makes up Brookview. Actually, when it comes to the investor side of things, on the operations side, on the acquisition side, we run things in a very almost institutional kind of way, where everything's very systematic, where we can very easily continue to replicate what we're doing, make it easier the next time, learn from how we're doing things, what we can do better, tightening the screws on those kind of projects, whether it's acquisitions or operations. But on the investor side of things, I purposely don't want to get too institutional. I would always rather have that hands-on approach. And by staying very organized, very accountable, we make quarterly distributions of operational profits on each of our deals. And thank God we've never missed a distribution on any of our deals. On all of those deals, you can set your calendar like clockwork on what date to expect your distributions. And I think by staying super organized but I never want to lose my personal touch on the investor side of things, because I feel like it's a place where you can set yourself apart from the thousands of syndicators out there, where you can do something a little bit different and really show your investors, hey, I remember you, you're not forgotten, and I value this relationship in a real way.
Yeah, the landscape seemingly has gotten noisy over the past couple of years, with lots of people jumping in and becoming syndicators, and a lot of them are overnight experts or self-proclaimed overnight experts. How do you set yourself apart from those folks?
Yeah, Stash, you and I know each other for a bunch of years at this point. I think where we've set ourselves apart is when we've done even raising up to $40 million of equity, we only take a finder's fee of about $150,000, which comes out to 0.2%. We are not getting rich at the closing table, and our money is, as a family, is in with the investors. So we are firmly tied to the performance of a deal. If a deal does well for us the way we envision, then our family will do very well. If, God forbid, a deal goes sideways, we'll by far take the biggest financial hit. So we don't just have skin in the game, we have the most skin in the game. And because we're not getting rich off of finder's fees, and really our only path to success is by a deal performing long term, we're not deal junkies. And we, as I'm sure you've seen, as you said, it's very easy to be a syndicator when interest rates are 3% and rent growth is 15%, and anyone can get in the game. We've resisted the urge to make acquisitions over the past 2 years when the only way, we've never stopped underwriting. We have extraordinary investor appetite for whatever we do next. But when we're talking about a bridge loan type of deal leveraged up to 85% at a 3 cap, when
And
we sit
everything's
back,
gonna hit just right.
everything has to hit just right. And if it doesn't, how is this going to be more valuable than where we're buying at 5 years down the road? And when we didn't see that kind of value, all of our Brookview acquisitions we only have fixed rate loans in our portfolio. We only leverage up to about 65%. To your point, with all these syndicators popping up, I think what's happened is it was very easy to get those deals done, but now we're all hearing stories of deals that have stopped making distributions, deals making capital calls, deals turning the keys back over to the lender. And
Yeah.
I think, and I'm curious to hear your perspective, but I think there's a sense of optimism that we're coming around the bend as an industry in the multifamily space where hopefully the hardest years were 22 and 23. And as we're heading into 24 and 25, we're going to start to see, as interest rates hopefully start to come down, we're going to start to see the deal flow picking up and the opportunities picking up. But a lot of those syndicators who have popped up, once you let your investors down, you can't raise money anymore going forward. And the brokers, someone like you who's a big player in the space, you're not going to vouch to your sellers for a buyer who doesn't have that kind of history, someone that you can count on to close it the way they promised they would. So I think we're going to see, as we're heading into 24, 25, the buyer pool dwindle down to your more serious kind of players, where it's going to be the Brookview type groups that have been around for a decade, who have managed through different cycles and have maintained their strength. And I think those kind of syndicators, we're not going to see them the same way we were in 21, 22, I don't think.
Yeah, I think you're right. We've seen a lot of 20. We had the front end of the year was great, and then they started ratcheting up interest rates, and then the tap got shut off, and it was just like, oh my God, what are we gonna do? And then 23, we scrapped through it and had a decent year. But then, especially once the holidays hit, everyone, I think, was just checked out. Everyone's, no, that sounds like a January conversation. But the front end of our pipeline, we've got a lot of opportunities, and we're headed out to San Diego next week for NMHC. We'll see you there.
Yes.
And so it'll be interesting to see what the sentiment is after that conference, what everybody's saying. But I think even though you guys don't take a big acquisition fee, everybody still lives on fees, or brokers do, lenders do, lots of groups do. You just need these to keep the engine running. Most groups aren't like you, where you have a large family that is the bulk of the equity. I think that is going to be driving acquisitions and activity, and I think you've seen it just as well as I have, that rates have started to tick down a little bit. So we'll see. I don't know, cautiously optimistic as always.
Yeah, I'm with you. Cautiously optimistic that we're going to be rewarded for our patience here. And a group like yours, and you and your team are a group that's constantly, even in the hardest times, have been successful at digging up deals. And you guys really hustle and don't take, you make sure you're on the forefront of whatever's going on. But I think, like you said, I think we're ready from where the peak interest rates were in the multifamily space and the agency rates. I think we've already come down a decent amount. And hopefully as that continues here, I think we're going to see the deal flow tick upwards. And I think there's going to be real opportunity for those that have stayed strong and stayed patient.
Yeah, I think so too. And just like you said, groups like yourself will be able to say, these guys are solid, they know what they're doing, they have the capital, they have a track record, let's do a deal.
Yeah, and what's interesting, sometimes the best deals are the deals you don't do. And I think a lot of most investors invest with a number of groups and a number of syndicators. And I think a lot of investors have been put into non-performing deals over the past 24 months. So it's interesting. I think by not putting our investors into those kind of bridge loan deals that have exploded once interest rates went up 200 plus basis points, and those deals were just underwater. I think we have more investor appetite for Brookview deals I think our investors have even more confidence now that we're not just going to put anything in front of them, that we're only going to put something in front of you if we see a long-term vision for it at the realities we're buying into.
Have you seen deals that you took a run at that maybe you lost out in best and final or somewhere in that call for offers process that have gone sideways? I'm just curious.
So the answer is yes, we've seen one or two like that, but more frequently, we do underwrite somewhat conservatively, but we're a group that we don't throw out 20 LOIs a week just to have a foot in the door. We underwrite meaningfully. I know, Stash, you deal with myself and Jake Weinstein, who leads our acquisitions, and we always give meaningful feedback. And what we've seen a lot is we'll underwrite to where we're confident. If we're putting an LOI out there, then come hell or high water, we're going to deliver on that number. It means a lot for us, for our reputation, for our relationships with people like you, that you have that comfort vouching for us. If we say we're going to do a deal, we're going to do it. I think what we've seen a lot over the last 2 years is if, let's say, we were getting broker guidance, just making up a number, to $50 million, and we'd underwrite the deal and get back to the broker and say, listen, we're shaking out at around 43. And they would take an offer from 48 from someone with no money, no hard money attached to it. And then all of a sudden, they're getting a 30-day free look at the property while they're doing diligence with nothing tied to it. And then they come back and say, hey, interest rates popped 75 bips. I need to retrade this. And then all of a sudden, so what we have seen is brokers coming back to us where we said, hey, we're at 43. And then they say, no, you got outbid. And then coming back to us 4 months later, hey, this fell through. Are you still interested at 43, 44? Where there's been some vindication for our underwriting process of the problem has been, though, by the time they come back to us at that price, interest rates had continued to climb, where even the price we were looking at it at, where it made sense 3 or 4 months earlier, didn't quite shake out by the time we're getting the second look. But I think we have been seeing a lot of deals being reaped below where sellers were initially hoping.
Yeah, that's interesting. What I feel like we've seen the past year, we did a study of where we were seeing the most optimistic value and then sellers' expectations. And that was oftentimes 20% spread between buyer and seller expectations. So I think that is driven from their need to hit their pro forma, their exit cap, things like that. And you could do that. You could write a 4 cap on exit when rates are at 2%, but when they're at 6%, you can't do that.
And I'm sure that's a huge challenge in your space. It's that seller shock kind of, what do you mean? I bought this for $50 million. What do you mean it's only worth $40 million now? How, and debt is the biggest driver of valuation and how a buyer is going to be looking at the deal. And I think that delta between seller expectations and hopes and financial realities has been really what's been slowing deal flow down to a crawl, is how to bridge that gap.
Yeah, if there was ever any doubt in anyone's mind, or if you're just learning investment real estate, it has been abundantly clear that rates are what drive values. That's clear. I'm curious. I have 2 questions, different things, but I'll throw them both out and I'll let you answer them as you will. Given that you have such a tailored approach, how has technology helped you run your business, run your practice? Because it seems like you run a pretty lean operation, but you've done hundreds of millions of dollars worth of deals. And then my other question is around brokers and what, in your opinion, sets one broker apart from another.
So I'll start with the broker question. I think your broker relationships in this industry are your lifeblood. And in our space that you and I deal in, Stash, it's very different than, let's say, in the single family space, where if one person bids $250,000 for a house and someone else bids $270,000, you're just going to take the higher number. But in our space, when we're talking about deals $40, $50, $60, $70 million, the broker is trying to achieve top dollar, but also there's a huge leap of faith to go back to your seller and say, this is the group you should go with. And it's not always, dollars always matter the most, but so much of it is really nurturing your relationships between yourself as the syndicator and the brokers you deal with. There's a finite number of key brokers in our space that control deals of this size. And you have to have that relationship. And I think what drives that relationship is being a group of your word, not telling the broker what they want to hear or what you think will get you to the next step. As broker, you and I, Stash, we deal with each other all the time, we have to look at 19 deals together that don't work to find the one that does work. And what creates that relationship that when you send us something, we immediately stop and say, Stash sent this over, this is something we got to look at. Or when we reach out to you, that we hope that you have that good feeling about us, is to always give you that honest feedback of either when a deal doesn't work, saying, hey, this one doesn't work, but this is why. This is where we're shaking out. This is what our underwriting looks like, that we're looking at it in a real way and giving you real honest feedback. And like I mentioned before, also, I think there also has to be a level of honesty in how you move forward in the acquisition process. That don't put out an LOI for $50 million if you have no intention of closing at $50 million, because you might end up getting the deal for $48 million. But in the process, you made your broker look bad. You made your broker have very uncomfortable conversations with the seller. And then if you want to be a long-term player in the space, what's your incentive to come back to me or want to deal with me again when you felt I wasn't dealing with you in a straightforward kind of honest way? And I'm sure you deal with all different kinds of syndicators and buyers in this space. And if you can, I see you smiling a little bit over there. I'm sure you have plenty of stories, but I think when you show your broker relationships that you value the relationship and you value the two-way street of trust that you're putting in each other, because it really is a partnership to get to the finish line on acquisitions in the tens of millions of dollars. And when you show that we can work well together, then my goal is never like to buy one deal from you. It's that when you see the next one, I want to be on the top of your list of potential buyers that you go, hey, David, you should be looking at this one too. And the way to do that is by respecting the relationship in a real way.
What do you think sets good brokers apart from run-of-the-mill? Or you mentioned there's only a finite number of us that are transacting in this space. What do you think those intangibles are? Or maybe they're tangibles, I don't know.
I think it's both. I think it's the groups that can truly dig up the deals and really have an exclusive, as the exclusive seller of the property. And I always respect very much when we have very honest underwriting, financial analysis conversations with each other. And your group, not just you personally, but the team you work with over there, we always feel when we're talking through a deal with you guys that you're not hiding anything from us. You're not just trying to polish it up and make it look all shiny and clean. You're saying to us, hey, here's the upside, here's where the challenges are, here's where things maybe could be done better. But I think when there's that honest back and forth on both sides, that's when you're dealing with a broker that you want to have a long-term relationship with. Because, oh, and I would also say, I love when we have broker relationships who aren't just sending us every single deal that crosses their table. When there's a pre-vetting process where you could tell some brokers, whenever they're controlling any deal, they're just sending it to everybody on their list. But I love when we deal with the group continuously, when they can start to do some vetting based on the vintage, based on the deal size, based on the market, where you could tell there's some thought before you're saying, hey, David and Jake, you guys need to look at this one. Because then you see we're listening to each other in a real way, trying to find the acquisition that works for both of us.
Yeah, absolutely. We try and tailor our outreach to you for deals only that are going to actually work for you. You don't want to waste your time or ours, because time is precious.
Yeah, and when it's a group that's sending us, Here's 400 units in Ohio, 2010 vintage, and here's 15 units in Wyoming that were built in 1958.
Yeah.
You could tell that they're just sending us everything. So you start to become numb to their emails because so many times you're hitting delete before you even open it because you could tell there was no thought put into it, as opposed to when it's someone that you have a real relationship with who think of you as a buyer, think of, hey, okay, Brookview's been active around the Midwest and Southeast, in deals 2000 vintage and later, or 90s vintage and later, aren't looking for a full value add play, deals up to 75 million, where you could tell that our buying criteria has gone through your mind. That's what makes us stop, like whenever we get a stash email to say, not that it necessarily work for us, but that this is one we need to look at in a real way. You have our attention immediately because we know you put thought into who we are and what you're sending to us.
Yeah. Yeah. We try and do our best. How about in doing that, we use some technology. How do you use technology in your practice?
For us, the technology comes in more on the operations and the underwriting side of things, where we obviously use sophisticated property management software and invoice processing and rent roll analysis. And our underwriting process is very formulaic in how we approach things. We try to, and where we really try to do is keep tightening the screws on how we underwrite, how we operate, how we run our custom financial reports to really serve what we're trying to accomplish for our investors. On the investor side, I would say technology, we have resisted the urge to go with, let's say, like an investor portal or those type of things for an investor. Going back to how we started this conversation, while there's a ton of value in those kind of portals and those type of automated investor things where they can pull everything, I'd always rather them ask me for it. Come to me, have the conversation with me, just to keep that flow of communication going back and forth. And we obviously have everything incredibly organized internally and all that. But I think on the investor side of things, when people invest with a private group like Brookview, keeping that personal touch involved in things, as long as you're being super responsive to your investors and immediate responses to questions, comments, requests, big or small. If you can keep that personal approach, I find it goes very far. But technology has certainly played a very big part in how we operate our existing portfolio and how we underwrite new opportunities.
Mm-hmm. That's awesome. What do you started the firm 10 years ago. What's your vision for the future for Brookview?
So I want Brookview to be around for the foreseeable future. In my mind, even though we've made 11 acquisitions and we've acquired $400 million of multifamily assets, I feel like we're still just getting started. And I have a real hunger to continue to grow this company. And I think the key to growth is not necessarily grabbing as much as you can as quickly as you can, but to take a patient and analytical approach in every phase of the real estate cycle. You've been in this business longer than I have, Stash, and I'm sure you've seen this isn't your first up and down in the roller coaster. You've been through harder times even in previous cycles. But what I find is you have to be realistic about every phase of the real estate cycle and how to be smart in each phase of that cycle. So you can't treat, in 2019, 2020, we were buying as fast as we can because the opportunities were extraordinary and there was just real investment opportunity. Over the last 2 years, it felt like more of a time, continue to underwrite, continue to look, but be patient. Don't feel like there's a gun to our head to make an acquisition for acquisition's sake. But if you want to be a long-term player in this field, then you have to be smart in each phase of the cycle. And there are phases to be more active, and there are phases to be more patient and focus on your existing portfolio and wait for the wheel to turn. I want us to be a group that takes every opportunity available to us in each phase of the cycle. And when there's opportunities to buy, we're going to be aggressively buying. And when it's a time to sit tight, then we'll sit tight and keep watching and keep waiting. But I think that's the way to be a company that'll be around for 50 years instead of a company that'll be around for 3 years.
That's awesome. So what are some of the, would you say, the toughest lessons learned? Maybe not toughest, but what are the most important or valuable lessons that you've learned over your either real estate or just overall career that you think are applicable for this conversation?
So I think I'll always go back to respecting your relationships, whether it's your investor relationships or your broker relationships. You want to be someone that people like doing business with, that people feel like holds to their word and is a group you can count on. And I think be really investing in those relationships on the investor and the broker side is so critical to being a long-term player in this space. And I think another really important lesson that we've learned, and I think everyone in the industry has learned, is there will always be unexpected challenges. And if you're underwriting opportunities to the skin of your teeth, as you and I have seen in the space, whether it's interest rates just flying through the roof, or insurance, which has tripled in certain markets and has become a tremendous operating challenge, or payroll challenges, or rent growth flattening out, I think you need to anticipate the unanticipated. And when you're underwriting opportunities, know that not everything is going to go perfectly. Not when you're planning what the next 5 to 7 years will look like, you're going to get some of it wrong. So underwrite conservatively, leave yourself some room in your numbers that you're not going in at the skin of your teeth, because inevitably something will go the way you didn't plan. And if you go in with that more conservative approach, when those things happen, it will still hurt, but it won't be like a crippling blow. It will be something that you can absorb, continue to move forward. And I think you just have to know that things will not always go your way.
Yeah, that's true. This morning before we hopped on this, I'm doing a renovation on a 6-unit project over, here in Cincinnati, and walking with the framer, and he's pointing out all these things that it's not going to break the budget, but we didn't fully account for that. Yeah, good thing there's a margin in there to be able to absorb that, because this is real estate. Everything takes longer and costs more than what you thought.
Yeah, you said it exactly.
Yeah. So I'm curious, where do you think the market is headed over the next, say, 12 to 24 months?
I think, and as we know, if any of us can accurately predict interest rates, we'd all be doing very well.
We wouldn't be here.
Exactly. But I do, speaking to our broker relationships and speaking to players in the industry, as well as just what we read in various publications, I think there's a sense of cautious optimism that we're coming around the bend here, and that we're going to be getting back to a place of interest rate stabilization, with it starting to trend in the right direction for us. As you mentioned earlier, we're already pretty far off of where the highs were in interest rates in our multifamily space. And I think as we head in deeper into 24, into 25, you and I spoke earlier in this conversation about kind of the gap between seller expectations and seller hopes and interest rate realities, and how that delta has really been making deal making extremely difficult. So I think as that gap starts to narrow, the deal pipeline has been so slow. I feel like there are so many sellers who have been holding on by the skin of their teeth, not wanting to sell for minimum value. And as soon as there's some movement here, I think we're going to see a lot more deals hit the market. And I think those good multifamily investment opportunities for seasoned buyers will start to return. And like we talked about earlier, I do think we're going to see less of your first or second time syndicators who are going to be the buyers of these deals. I think we're going to see it be more established players in the field who are going to be the buyers of these deals. I don't think your first or second timers are going to be able to get investors to trust in them. There's a lot of investor weariness and leeriness of groups that don't have the history. And I think we're going to have a more seasoned buyer pool going forward. And I do think we're going to start to see deal flow pick up, and a lot of groups who have had a dry powder waiting on the sidelines, jumping back in with 2 feet here.
Interesting.
What do you see, Stash? What are you anticipating?
I think similar to what you're thinking, there, like I mentioned, we have a lot in the front end of our pipeline right now, and it's just trying to figure out how to effectively navigate all these opportunities that have come in. Which ones are real? Which ones are still is there still too much of a gap? Staying on top of them and trying to understand where they are actually sellers. Is it really at the number that they're telling me, or is it maybe something a little bit less? And that's a tough dance, but that's our job. So, yeah, I think that there's certainly hopeful. There are more opportunities coming here in 24, and then certainly through 25 as well. And I think also, and it's not to be political, but I think the fact that we are in an election year, that we'll see some lowering of the Fed rates, which will cause interest rates to continue to lower, I think probably 3 times. At least that's what I'm hearing. We'll see. I don't know.
Yeah.
What, for somebody who is trying to get into real estate, what advice would you give to them as either a principal or a broker or somewhere in between?
Yeah, I would say, whether it's real estate, whether it's any business you're trying to start or get into, I think you need to be a communicator, you need to be a listener, and you need to be accountable. And your relationships in any field you're in are so critical to success. Like, being someone that other people want to do business with, there's no substitute for it, because most people on any side of any business, you typically have somewhat of a choice of who you want to work with. None of us invented a light bulb. None of us have a patent on something irreplaceable. Like someone like me, I'm a real estate syndicator. There's a million of me. I'm not doing something profoundly different. So what can you do differently? It's how you present yourself, how you respect your relationships, how you respect other people, not like in the space, like let's say someone like me who's a syndicator. When you deal with brokers, it's not trying to win the relationship, trying to get one over on the other person. It's trying to be a good partner to them and say, hey, how do we help each other succeed? And just because you're doing large deals, it doesn't mean it needs to be a nightmare. There'll always be things that come up, but when you handle yourself correctly and you try to just be a deal maker, you try to be someone that's really pleasant to deal with, then people tend to come back to you to want to do business with you multiple times. And whether it's investors, brokers, vendors, employees, whatever it might be, you treat people with respect, you hear them, you communicate with them honestly. And I think that's just so critical to success.
I think that's probably why you and I get along, because we both have that same philosophy. I always try and treat people as honestly and upfront as possible. And you might not have good news, but you just want to lay it out there.
Yeah, couldn't agree more.
That's awesome. David, thank you so much, man. I really appreciate your time.
No, this was Stash. This was really a pleasure. I love what you're doing with this podcast. I'm very honored to be one of your first guests on here. As you're picking up steam, and I'm very much looking forward to spending time together in person at NMHC in San Diego next week.
Yep.
And thank you so much for having me as a guest here.
Absolutely. Thanks so much, and have a great day.